we got
We can
Tom.
make this work.
We got Tom Kennedy from JP Morgan. You are clearly a numbers guy. There's tons of data that I'm sure you're going to share with us today, but it's not going to be boring. It's going to be fun.
It's the good data.
Only the best data.
It's only the best data.
No, thanks for having me. I'm excited to be here. You're right. I'm a recovering central banker.
Yep.
Turned investment professional. I joined JP Morgan about 7 years ago. But I really think of myself as just a data scientist, a data hoarder, and trying to stack that evidence to make a decision today, knowing that no one could possibly know what will happen tomorrow or 5 or 10 years from now. So buying a piece of real estate is a long-term commitment. Got to have the best decision-making process now. And the luxury of sitting at JP Morgan is the data is unbelievable.
Yeah.
Right.
Even when I was at the Federal Reserve, we would call JP Morgan to look for what types of data. But just to put it in perspective, you could look at market cap as the best way to summarize access to data. JP Morgan's market cap for its stock, twice that of the next bank. But about 50% of all households have a product from JP Morgan in their house. 20% of small businesses bank with us. So the access to information is unbelievable. And the ability to just fine tune that and make a decision, I think it gives us a competitive advantage.
Yeah, absolutely.
Yeah, we always talk about data and how important it is, but the data is only as good as where it's coming from.
Yep.
Yeah.
You clearly have a lot of sources where it's coming from.
Tom, that's the technical background that you've had. So you started as a data scientist, or
I think
grew into that role.
Yeah, exactly. I think a scientist moniker is just so blah and boring.
Yeah.
If you're
Let's go with doctor.
Yeah,
You're a data doctor.
But what the data is meant to do is to remove bias of what we do. Look, in our business, what do? We walk up to a property and say, wow, this thing is beautiful. I want to own it. Okay, well, what's the going cap? What's the NOI growth possibility? There's just so much more to it. And when you statistically break down what real estate is, it's the single biggest macro asset that there is.
Right.
Do people have a job? Are their wages going up? What's their capacity to grow NOI if you're the owner? Or what's your capacity to pay a higher rent if you're a tenant? So somewhat simplistically taking this real estate asset class, but macro-driven data edge helps.
It's unfair. I mean, a group like JP Morgan, you're so big, you have so much resources at your disposal. It's like it's like playing against Goliath. I feel like if we're trying to get a deal done and buy a property, and you guys are too, I'm thinking to myself, well, something must be right. You're looking at it. I'm looking at it. There's something you're seeing here. So let's dive into real estate and how JP Morgan is looking at the asset type today and just being a alternative form of investment.
Yep.
Yeah. Before we go right down that role, why don't you tell us what is it that you do day to day?
Yep, that's
so
a good question.
You mentioned the data. You told us that you came from the Federal Reserve. What's your day to day here at JP Morgan?
Yeah, the day to day is hitting the main objective of our business, which is to have best in class commercial real estate investing. So my team is helping make those execution decisions on acquisition, disposition, and using our data edge. I'm spending a lot of my time with JP Morgan and Chase data. It's anonymized, all of it, but what is happening in specific parts of the country for wage growth, asset value growth, what's happening with migration patterns across America. It's an interesting data point, but if I sat here and told you, wow, Sunbelt migration in America, 5 years in the rearview mirror, unbelievable, everyone moving to the Sunbelt.
Right.
But that migration pattern is actually changing. And now increasingly you're seeing folks move towards the Midwest.
Yeah.
That would have a changing way you think about real estate.
Of course.
Why? Most people are moving from big blue coastal states where there's strong wealth and moving to places where things are more affordable. I'm trying to use like the words a little bit deliberate in that.
You're being nice.
Affordability matters, though.
Of course.
So if you have migration data edge, that's important. So that's the first point.
And you're telling me you're not just looking at U-Haul travel data, right? And where they're dropping off the trucks?
I'm a data hoarder. I'll take any data I can get. But that's half my job. Making the investment, acquisition, disposition, helping the teams do that. And then the second is bringing the insights that we have to the world, shining a spotlight on this asset class. Do you think just about everyone in the world could and should be able to own real estate? Some of the wealthiest families in the world, this is their biggest asset class that they own. So I'm trying to bring insights to help people gain exposure to this asset class because I think it will generate wealth for them.
Yeah, absolutely. If you're still waiting on support tickets or chasing down wires, here's your sign. You've outgrown your current investor portal. InvestNext gives you modern raised infrastructure with waterfall automation, ACH payouts, and seamless co-sponsor support that scales. No more bolted on features or just live with it answers. Your next raise deserves better. See why today's GPs are switching to Invest Next at investnext.com/nocap.
Well, let's talk. Let's just dive right into it. I mean, there is what a lot of people believe. I think unquestionably there is a dislocation in the market right now. Is this a good time to be getting into real estate?
Yeah.
And what are you seeing with the tariffs and immigration? And I'm sure I'm missing a couple other big ticket items that are all interrelated, including treasuries. How's that impacting the business?
It's a lot to unpack.
I think at the highest level, before we go sectors, before we go into specifics about what's driving the asset class.
What's your macro view?
It's a very odd time for real estate. There's only been 3 or 4 corrections in commercial real estate prices. So prices of properties over the last 30 years. 3. The COVID was one of them, but it was a very unique shift. Prices came down on average almost 20%, yet net income or operating growth at the properties actually grew. In all your prior shocks, you actually saw those two things move together, which in my brain makes sense. Right. Property values go down because my ability to generate income from owning it went down. Great. COVID was so unique in that rates came up a lot, but the economy didn't slow down. It didn't have the traditional Federal Reserve recession where people lost their jobs in a meaningful, persistent way. So NOI growth kept moving. Very unique time. But in history, anytime you see a 20% correction in an asset, any asset, stocks, bonds, real estate, it's generally a good time to buy. Right. We wrote a paper on calling the bottom in commercial real estate last summer. And at the time, people were didn't believe it, didn't want to get on board with that. It's aging well, I think, so far. But at the moment now, we're moving through these stages of higher for longer interest rates. The first stage is this revaluation of assets. The second stage is now higher interest rates are preventing developers from building new supply. And that has multifamily implications. It also has industrial manufacturing implications too. So I think we're in that second phase now. People are believing, and the best stat takeaway is aggregate starts in the CRE market in the US are down about 75% from the peak. And deliveries usually follow about 6 quarters later. So
and when you say 75% from the peak, you're talking about every asset class.
All macro level.
Macro level, every asset class. So inevitably, real estate as a whole just goes up. You've now cut the supply pipeline off. We're not talking about a single game. It's not, there's a shortage of housing, there's no industrial space. Real estate as an asset class already set to outperform whatever it's doing today.
Yeah, I think you're getting this environment where demand held up more than you thought. In the face of high interest rates, if you sat and told an economist, interest rates are going to go up 5%. What's that going to do to demand? Demand will come down. Yet in our asset class, in commercial real estate, we actually had operating income growth. It's odd. But now those high interest rates are preventing this supply from coming. And we know there's more demand. We know there's more people. We know there's a changing economy for manufacturing, industrial, and we're going to need new supply. But if we can't buy it, those imbalances cause prices to go up.
You mentioned that you had some research a while back on whether we hit the bottom.
Yeah.
What did that say, and how's that kind of playing out as we speak?
You've had about 5 quarters of aggregate commercial real estate prices trading sideways. In the summertime last year, so summer 2024, we said the supply picture is just going to become such a challenge. And if we can avoid recession, which we think we will, you're going to see prices start to rally. And I think that's happening. We have about 50,000 plus multifamily units that we have. So we're getting over 1,000 new rental agreements every month since March. In the face of tariffs, in the face of rising recession risk, we're seeing net operating income growth of about 3.5% across our portfolio. That is the highest growth rate in rental income we've seen since summer of 2023.
Sure.
So the market's turning. We're feeling very good about calling the bottom last summer. But I think Wall Street's coming around to that. I think the bottom is in, I think is the way most people
you
think
saw
about
John
it.
Gray call it. I mean, Blackstone said they're getting back into office months ago. So it's definitely a lot of signaling. And for you, it gave you enough confidence kind of summer of 2024, seeing that your income really is going up, even though there's no trades happening or they're happening kind of at these non-pattern prices. You guys felt good at that time that you could say it's a bright future for real estate.
Yeah, it's right that you're bringing up the transactional piece now too. Transaction volumes are picking up, still very, very low, but I think you're ending up in this world with haves and have-nots for real estate.
Yeah.
And the office market is the most obvious one.
Yeah.
We're doing this in Manhattan, right? You come up towards Grand Central or into Midtown Center, and Park Avenue prices are rising rapidly. You go 2 avenues over, that's completely different.
Yeah.
So the quality of asset really matters. And this is also a real shift in a higher for longer interest rate environment. If we just sit here and simplify our life for the last 15 years, think COVID, think global financial crisis to COVID. If you looked at the stock market, you could try to explain what was moving prices in aggregate. Interestingly enough, that statistical variable was not earnings. So if you were a high earnings business or a low earnings business, your stock performance didn't really differ.
Right.
Rates were low, buy an asset, lever it up. Like that was the factor that drove performance. But in a high interest rate environment, that's not going to work.
Right.
So we're seeing it in real estate already, but high quality properties versus low quality, there's firm differentiation. And office is a place where that's happening most
So we're going to do something selfish because we have this data mine literally right now.
Yep.
I want to touch on every class.
Okay.
But let's start with, what are you seeing as the most interesting right now? Which asset class has had the most change or that's significant, whether it's going up or down? What's really piquing your interest?
The changing industrial sector is most interesting to me. But then what's also the obvious place to be investing is multi. So let's go after both of those. Let's start with industrial just because I think it's most interesting. If you look back since China joined the WTO in the early 2000s, 2001, the warehouse and distribution square footage in America has gone up about 4.5 billion square feet. Over that time, manufacturing space has gone up about 300 million square feet. So everyone has their favorite globalization chart. That's my newest favorite, where America, the industrial landscape changed and was just about bring stuff in, put it in a warehouse, and send it out to people. Now, I don't know about you guys. I still like my Amazon deliveries today. I want to order it after this. I want it to come today. But the way we're going to move goods through the world is changing. And when you talk about warehousing and distribution, I think most people think T-shirts. But what about the chips that go into your phone? What about the refined rare earths that go into your phone? And when we wake up today as an American, what we know is this phone does not work without China. So the rare earths, if you've been hearing senators and congressmen talk about rare earths.
Of course.
Refined rare earths are the rare part. Rare earths are not rare. In America, we have abundant rare earths, but we send them to China to be refined. 90% of the world's refined rare earths that go into this phone, go into your EV, go into your batteries, come from China. So the manufacturing place we end up with is a world where we're fully reliant, but on critical industry. I think that's got to change.
So is that changing with things like the CHIPS Act and like I mean, what impact is that having?
But Jack, you're hitting on it. Everyone wants to talk about tariffs.
Yeah,
tariffs don't onshore our capacity to do refined rare earths.
Right.
You need the CHIPS Act, the Inflation Reduction Act, maybe even remember President Trump floated Stargate. Maybe he's going to do his own version of this, and no one's talking about this.
Yeah.
But since those programs, Inflation Reduction Act and CHIPS Act, you have stimulated over $1 trillion of private investment.
And that was pre-tariffs, interestingly enough, right? So
this is all happening in the background.
Yeah, right.
Very little headlines versus a very impactful exercise here. But there's 5 states where the government, CHIPS Act, Inflation Reduction Act, is mostly spending. So they're doing direct investment. It's in New York, California, Texas, Arizona, and Pennsylvania. Don't hold me accountable to that last.
Okay.
But what's happening is where investors are following is not necessarily aligned to those. You're getting in states like Texas, Arizona, and New York a 5 times multiplier. This is your fiscal multiplier in your Econ 101 class. Government spends $1, you get 5 times as many. And these 3 states, what do they have in common? They have lower regulatory environments, abundant land, water, and power. So you start to see the way the future of the manufacturing sector will change. And Liberation Day, when the tariffs really got energized, we saw a big change in our portfolio about inbound calls for tenants that wanted to be in our high power capacity manufacturing space, air and defense businesses, robotics businesses. So onshoring to me is not T-shirts. It's this industrial capacity for critical industry. And it's changing.
It's the machines that build the machines.
And are you already seeing the numbers follow that? Are you seeing population moves? Are you seeing new constructions? Are you seeing occupancy levels dip or rise based on that?
The migration patterns that we can see from Chase to some degree follow this.
Okay.
But let's not take that too far. Migration is almost always defined by affordability. Even during COVID, remember the stories of your friends like, I'm just going to pick up and move to Montana because Montana's cool. Yeah, there's some people doing that. But most people are moving to Sunbelt states where life was more affordable and it had less to do about, I don't know, Yellowstone, the show. I don't know.
Right.
But what we are seeing in places like Arizona and Phoenix, something called the TSMC effect. Taiwan Semi is building a plant. And some of our competitors want to own the plant, the data center. Mm-hmm. That to us is not really real estate. That's more of an infrastructure play, and maybe we want to talk about that. But you're seeing the TSMC effect around it where now you need retail space. You need grocery anchored retail. You need multifamily. You have these knock-on multipliers, and that's a way to invest in an uncertain world. The government is going to do this, we think, regardless of what happens to the economy. And that's just creates a supply and demand imbalance for us.
Yeah.
So right now, what's the most interesting asset type for you guys?
Multi.
It's multi.
Yeah. And the case for this, I think, is well understood, but let me add a few more data points to it. Affordability, single family affordability in this country is 1988 all over again. Why do I bring that? My dad loves to tell me how hard it was for him to buy a house in the 80s.
17% interest rates.
No, he makes it up. He says 30% now.
It just
gets higher. It gets higher each time you guys speak. Yeah.
Uphill both ways, you get the joke. But the problem then was that rates were high. But the problem now is that prices are very high. And affordability is more than just interest rates. Yeah. So in a really simple affordability model, you have what is your wages?
Right.
What's the price of the asset and how much to finance it? And right now, unaffordability is a big problem.
Yeah.
But yet, we still have a generation of millennials that a big cohort of them are living with their parents. Sure. And the American dream is getting harder. So we kind of know that story. We're short, by anyone's estimate, 4 to 6 million single-family homes. So folks are being forced to rent. This is a fun stat. The median person buying a single-family home right now, first-time home buyer, is 38 years old.
Yeah.
I don't know about you guys. Crazy. When I bought my house 10 years ago, it was 28. So the world has changed a lot. Higher for longer interest rates.
Well, and I think renting's become a lot more acceptable. Yeah. For a multitude of reasons. I don't think people want to stay in the same city their whole lives. Right. Also, I think that's part of it. But what you're saying is now's the time to get into multi.
So the stats to add to it are we've seen wages grow for the last 2 to 3 years, but rental incomes haven't kept up. So there's space for owners now to say, okay, so there's not enough supply for you to move.
Right.
In aggregate, some cities still have a supply problem. If for the next 6 quarters, we're unlikely to get more supply, and your wages have gone up, so I can push on you.
It's a bit crazy. It's a vicious circle, right? Because like your prices, you started with asset prices. Your asset prices far outgrew the pace that wages have grown over the last 10, 20, 30 years especially, right? On top of that, no supply.
Yeah.
Landlords raise the rent. Your wages still aren't growing fast enough. People are going to continue to get priced down this funnel. So what do you think about that?
Well, what happens if tariffs, and I don't want to talk too much about tariffs, but what happens if tariffs does have an impact and we do go into some sort of recessionary environment and then wages are getting impacted?
Yep. The tariff piece is a very regressive tax. America has moved away from tariffs for the last 100, 150 years, and it's been replaced.
Is that right?
Correct.
Like we've never really used that as a tool.
Well, the chart that most will show is like the effective tariff rate over time, and it's been falling persistently for over 100 years. So why is that? Well, the government knows how to tax you. It knows where you live, and income tax and sales tax is just a more progressive way of doing taxes. The wealthier that consume more or buy higher assets will pay more tax than lower. But when you break apart America, the top 10% of Americans of their income spend about 13% on goods. The other 90% spend about 27% on goods. So it's a regressive tax on those folks. So as you map that, if we hit a recession, that's bad for real estate. It's a macro asset class. But if the tariffs are just a tax on less wealthy folks, it becomes haves and have-nots on assets again. And what we've seen in our portfolio is if you target attainable housing, I'm kind of using air quotes here about some people will call it affordable, but where's the like median income American that makes $110,000 and wants to spend 20 to 25% of their income on where they live? That's what we're targeting.
Yeah.
Because we've seen we can push rents annually 1-2 percentage points higher than in the luxury cohort.
Yeah.
And so we're hitting this like middle sleeve. And as we look out over the next couple of years, the supply picture, the ability to pay higher rents, where is the world most affordable? That's what we're triangulating.
Yeah. So it's a good time. It's a good time to be in multi if you're not already, is what I'm hearing.
A lot of platforms say they support GPs, but only a few actually do. If your current system makes complex raises feel complex, it might be time for an upgrade. InvestNext is built for GPs who move fast. Integrated payments, co-sponsor visibility, and a portal your LPs actually want to use. While other platforms pivot to add-on services to plug their software gaps, InvestNext is doubling down to ensure our product works for you. Raise with the tools that move like you do. Learn more at investnext.com/nocap.
Yeah, and look, looking backwards, the Sun Belt was the place to be.
Right.
Yeah.
Now it's a bit of a moving target.
It is.
We just saw Morgan bought, what was it, 30,000 or 10,000 units in the Midwest. And so now I think now they have 100,000 units under their belt. So it was a big surprise that they moved into the Midwest in that big of a move.
And look, it remains to be seen. I think when we talk about it, Sunbelt was great. Now I got to have the next great thing.
Yeah.
Sunbelt rents are still growing very
it's not
healthy
going
for us.
anywhere.
Yes, that's right. You're just seeing some of that rush, and what I can tell, the affordability, bright shining light that was the Sunbelt dim a little bit. So it's still affordable relative to being on the coast, but now the Midwest is screening a little bit more affordable. So, the temperature on these things
Let's talk about
changes.
a different asset type and one that I don't think you guys are very involved in, but correct me if I'm wrong, and that's data centers.
Yes.
But everyone's talking about it.
Yeah.
And you were talking about infrastructure also.
Right.
And I feel like so much in real estate now with AI and every other new thing that pops up on a weekly basis, right? We're discovering new asset classes by the month. So where are we starting to really cross the border into what's infrastructure, what's real estate?
So I love what you're saying, though.
Yeah.
This attack at extended sectors in real estate is really folks like us trying to find where can we institutionalize?
Yeah.
Where is there still some inefficiencies that we could take advantage of? Data centers, as an example, though, is very institutional, and from our perspective, is not real estate. It's not real estate in the sense that we would think about it. More like infrastructure. So we do not own data centers. It doesn't mean we don't like the asset class,
right?
But it has challenges for what we offer to our clients for real estate. Again, what's our goal?
Because you're saying it's mostly infrastructure-based, energy-based, not actual physical real estate.
So let's put some points to this. Green Street did this great report last year that talked about the average industrial trade versus a data center trade. So average industrial traded in 2024, something like $180 a square foot. Great. Average data center trades at $450 to $500 a square foot. Okay, what's the difference? Well, the difference is the tech that's inside and the capacity to meet your AI demands, most likely. Great report, great article. I was trying to find it to send you guys before we came. Google, in one of their data centers, had to change the cooling system 7 times in 3 years. So is this real estate? Is this infrastructure? But that if you just looked at the price per square foot, it looks like 2/3 of the value of a data center is tech, 1/3 is real estate. Okay, well, let's be a tech investor for a second. I don't know about you guys. I don't have an expertise in compute power, how to run a data center, and tech obsolescence is a real thing.
Yeah.
Microsoft backing away,
Yep.
and DeepSeek showing you that you don't need to pay 10 times as much for one token of AI
And
trade.
meanwhile, they're putting up a lot of capital into these projects.
The last point, and the last point is that, and no one talks about this, data centers do not trade cheap to any industrial anymore.
Right.
They did for a really long time. So number one, I have this asset that is more tech than it is real estate. It is very exposed to tech obsolescence, and now it doesn't trade cheap, and it's very hard to sell. So when I put that into what am I trying to offer my clients? I want income for you, some appreciation of asset, and in the event something happens, I want to be able to trade you in and out of it. This asset class is really hard for what we're offering.
Of course.
So as we move forward with AI, we'll need this infrastructure. And as we kind of move away and decouple from China, we'll need it. But do I want to offer it in a real estate offering? I don't think so.
Yeah.
So on just talking about China and kind of the let's call it a Cold War that's kind of happening and the deglobalization of things. What impact is that having on real estate right now?
I think for anyone that's investing, they need to change their mindset, and it's happening way too slowly. We're all about the same age here. I'm a little older than you, so I'm happy to be a part of your cohort. But we grew up in a world where everyone offered you a 60-40 portfolio. Mm-hmm. What is it? 60% stocks, 40% bonds. You're going to expect to earn, call it 6 to 9% returns, but with little volatility. Stocks and bonds were diversifiers. And what does diversification mean? When stocks went down in value, bonds went up in value.
Right.
Mm-hmm. Beautiful. Great. I think most people our generation think that relationship has existed forever. And it hasn't. It showed up in the late 90s. And what also happened around the late 90s? Globalization started. China said, we want to supply the world with goods, and we want to be the cheapest provider to do that, gain market share. So inflation pressures came down and interest rates came down. Mm-hmm. With tariffs and with what we talked about, this critical reliance for phones and things, I just don't think that's likely anymore. And for the last 3 years, the inverse correlation between stocks and bonds has not existed.
Right.
It's so, you go on CNBC, you talk about Bloomberg. When are we going to say maybe it's not coming back? And I quite honestly don't think it's going to come back. And, put yourself on the line for something. I think that's what it is. So what are we going to do different? What's our generation going to do different? Well, I think we'll still own stocks.
Yeah.
I think we probably still won't own bonds, but where else can I find income, appreciation, and some finite value of real estate? I think it's got this new diversification angle for it. So what's our task? What do I need to do? I need to come up with products that regular investors, your friends, your cousins can invest in. Mm-hmm. Right. And that's the democratization of alternatives.
And it was called alternatives for such a long time. It's not really alternatives. It is funny.
I always thought that was funny.
Yeah.
Like alternatives.
Because real estate got grouped in a bucket with other liquids, private credit, which is now, every other headline, private equity, like all these niche, illiquid, long-term investments got grouped into a bucket. And then they just completely forgot, oh wait, no, real estate's actually a pretty big asset class, and we're in it constantly. And then
we're in it constantly. That's right.
And then I know they hate the crowdfunding label, but we have the crowdfunding that tried to democratize it. Sure. Your favorite word.
Yep. I like that word.
Yeah, it's definitely an interesting time. And to your point, right, when you were talking about the 60-40 portfolio, the 38-year-old home buyer who was 37 and renting just a few months prior, they need to start betting on alternatives and crypto and everything else. And that's probably the rise of all this stuff.
I actually think they already are. I think if you talk to millennials, Gen Z, I think they know more than maybe the past generations have.
We definitely have more information.
Yeah, 100%. You see all these influencers, quote unquote, getting rich off of syndicating, whatever.
Well, let's throw some data at this.
Yeah.
We did a survey last year about with the biggest, wealthiest family offices that we bank at JP Morgan. They had 45% of their assets in alternatives. And I think they're called alternatives, to your point. I hate that name too. Yeah. Because they're alternatives to the 60-40. We all grew up. That's what you did.
Because if your business is in the 60-40, you want to call it an alternative because that is to say it's not the main thing. It shouldn't be focused on as much.
Class.
It's second class.
Yeah. But the wealthiest people in the world though own alternatives.
Right.
And of their allocation, 20% is in real estate. So you sit and say, these are the wealthiest families, generational wealth.
Right.
20% of their assets in real estate. Now you go to the average person walking around, if they have an investment account, less than 5% of it is in alternatives. Yeah. So there's big growth there. And you could say, you're getting pushed into doing something you don't want to do. Well, the number of publicly traded companies in America is half of what it was in the mid-90s.
Yeah.
When this generation, our generation, figured out what was happening in the world. So the world now has to adapt. Where's the supply? It's mostly in alternatives, the private space. And what's the asset classes in there that you want to have? Yeah. Now, we could talk private credit. We could all of these things. But there is a growing menu for people. And banks, asset managers are reducing the biggest burden for alternatives, which is the illiquidity. Mm-hmm. And now you're with Open-ended funds being an obvious one, non-traded REITs.
Yep.
There is access points that are different. And in 10 years' time, will we tokenize these assets?
Sure.
Will there be even more liquidity? Yeah, I think we're heading towards that rather than going back to the old ways.
Yeah.
So that's why I go after your democratization, Jack.
Yeah. No. And tell us what some of these strategies are to democratize access to alternatives for, we talk about the institutions a lot, but what about just more private capital space?
Yeah. I think the traditional way that people think about alternatives being illiquid is they would draw down funds. Private equity. Hi, Jack, invest your money with us. It's a 10-year commitment. We'll call you when we find great opportunities. So you need to have that capital there. That was the traditional way people think about alts.
Yeah.
Now you have open-ended funds, non-traded REITs that are adding liquidity to a real estate asset that is rather illiquid. Now, this changes the jobs of people at asset managers. You actually need a liquidity profile. And in real estate, multifamily is the most liquid asset class there is. And data centers are way far behind.
Right.
Almost no trades for data centers. So one way to think about liquidity. But now you have players from some other asset managers tokenizing assets so that they can trade just about every day.
Yeah.
That's a growing new world. It's mostly happening in private credit. But why couldn't it happen with other assets? And what does tokenize really mean? It means put this very illiquid asset into a box on a blockchain that I can trade it with you, Alex, in any way I want, at any time I want.
Is JP Morgan involved in things like this, or is this a big push?
So in the JP Morgan as a big institution is already doing this in the repo market. We have on a blockchain tokenized repo trades. So those are overnight transactions. And this is research we're doing now to see how you could do this in the future. The point to bring it up is players are already talking about
Interesting.
But the liquidity profile just for our generation, drawdown to a tokenized daily liquid asset, completely different.
I see a world where any sort of equity raise becomes so easy.
Yes.
Because of that.
Yeah.
I mean, what's the number one worry? Oh, crap, I'm going to put all this money up and not be able to get it back well, now you can tokenize it and get it back whenever you want.
And look, you could sit some of the most prominent investors at this table. On the right-hand side, the people that hate this idea, they're illiquid, you can't trade them.
Yeah.
And the people on this side that say, no, price discovery is the best thing that could happen.
Yeah.
And
that's a good point.
To some degree, both are right. And it's a challenge.
Yeah.
But REITs, liquid REITs, have done this for a long time. And those are really important signals for people in the private market about where real estate is going. So there's an environment where all of this will coexist. But I think the thing I feel most confident about is we're going towards more liquidity to this asset class, not going the other way. And that has new dynamics, new players that can play. And it starts to change what you think valuation looks like.
Fascinating. It's crazy. Things are changing. What are you looking at in terms of just portfolio allocations now for your institutional clients? I mean, obviously, I think in talking to you, things are moving more to alternatives, but how much are they and what type of alternatives?
Yeah, the broad aggregate alternative space, I think what people are finding most interesting right now is infrastructure and real estate assets. Those tend to be grouped together.
Okay.
But for the reasons we've hit on, but to say them deliberately, they offer you income, the potential for appreciation, and they have diversification benefits from your more risky, call it 60, the stocks. Private credit is seeing massive inflows post-COVID. What is private credit? It's a loan to a middle market business, and it is giving you, for the most part, short duration. So interest rates that reset almost every day. Right now, those are yielding you somewhere between 8 and 12%. And private equity is still really challenged. A lot of the assets there haven't been remarked, but remarked meaning they haven't adjusted the valuations of the businesses that these private equity firms might own. And that's a blanket statement that's probably not even fair to say. Some of them are doing that. But across these three, what we're seeing is people migrate towards infrastructure, real estate, private credit. And if you guys look across the non-traded REITs that are in existence out there, a lot of them have debt in them, mezzanine debt on real estate, because interest rates are high.
Yeah.
And if my goal is to offer you as my client 8 to 10% returns, I can do that in mezzanine debt. I can do that. I can get you pretty close to 10% on a loan to value of 65%, and the underlying asset is down 20% from its peak.
Yeah.
So that's another consequence of higher for longer. These debt products really can service a client's goal, which most people, it's like
which
7 to 10%.
explains why I feel like the debt markets are a lot more open right now than equity.
Yeah.
I mean, how are you looking at that right now? How are you looking at just equity versus debt, and how are you approaching credit in general right now?
The differential between equity and debt on expected returns for the next year are very similar. So again, if you're someone who's investing and saying, I want, now to your point, it's tough because that high cost of capital makes it hard to build, hard to develop. But if you're an investor and you want to earn 9% returns with the least amount of risk, the debt looks better than the equity.
Right.
That's why these non-traded REITs, which are traditionally just equity holdings in real estate, now have debt showing up. So when you think about these, our platform is highly diversified. We offer debt products and equity products. Why do we do that? Well, business is more resilient if I can rotate and change between the two. But the debt offerings, again, we have the best data. We're seeing hundreds of deals a day, or just prop ideas. And what you're seeing there is haves and have-nots again. Some of these properties, trophy properties, are borrowing at SOFR, so the overnight rate plus 100 basis points.
Yeah.
It's unbelievably tight.
Yeah.
It's not what you would expect if we were walking into a recession. And then raising equity on maybe a similar deal is much harder.
Right.
So you have this trade-off happening. I think they're both going to be an increasingly part of how investors want to invest. Right now, debt looks really solid. So you need to pair it with equity allocations that, again, you feel great about. High earning, high potential for appreciation.
The news is important, but if you're a busy real estate professional like me, you don't have time to skim through dozens of dry and ad-filled media outlets each day. That's why I read the CRE Daily. It's a free email newsletter that cuts through the clutter and delivers concise, witty commentary on the latest trends and transactions in commercial real estate. If you're a commercial real estate professional, you owe it to yourself to try it out and stay on top of what's happening in the industry. It's only 5 minutes a day. Visit credaily.com to sign up for free.
Got it. Makes sense. Let's talk about a different topic, and let's talk about AI.
Okay.
And I think something that, again, I don't want to talk about AI in particular too much, but just the impact AI is having on jobs. And also, just correlating that with, tightening of the border.
Yeah.
Where do you see that impacting real estate?
I think we need another hour to do this topic here, but
there's a lot to unpack in that one.
No, let's hit immigration, because the immigration thing is a meaningful adjustment for the U.S. economy. 2023 was a once in 100-year surge in immigration to America. The population grew by about 1% just from immigration, 3.5 million people. Now, the going negotiation is where they come from and why are they here. Most people were on a program where they were eligible to work. They had employment authorization documents, they could come and work. From an economist perspective, you can get GDP with more people or productivity. And to your question, Jack, immigration and AI should be together. If I want growth in this country, productivity, that's AI, growth is immigration. Fast forward to today, though. Immigration into this country is at a standstill. It's just about no immigration. And a lot of those folks that had employment authorization documents from the Biden administration are losing those. They were really only 2-year deals. So you're going to see a contraction in the workforce. And where is it going to show up mostly? Probably on the coasts, California, Texas, New York, where in construction, where I think we have good data, about 40% of construction workers in those areas are foreign-born. So it's going to have an impact.
Yeah.
Tariffs are raising input costs, and now this decline in immigration is suppressing supply of workers and should push up prices too. So that's an issue. Can AI change things in our real estate space? At the construction level, manufactured housing will have an AI component very soon, if it doesn't already, and is meaningful, will have productivity benefits. So far, they're just really hard to see. And again, we talk about what jobs are going to be displaced from AI. Sure, we could come up with some, but it's really, a lot of them is very gray. And, this is maybe my old central banker economist hat. Labor markets are really dynamic in this country. And there's a really fun report from probably 2018. And at that moment, it said 60% of the jobs that exist today in America didn't exist 60 years ago. So there is it's a very dynamic labor market. I think it will be fine. But the productivity benefits from AI, I don't see them yet. It's possible they're happening, but it's just not obvious to me that it is.
Really? The chat bot isn't solving everything for you?
Listen, I wasn't great at coding, before ChatGPT. I'm pretty good at it now, but I just don't see any businesses inside JP Morgan, the biggest bank in America. I don't see us. We're not laying people off with AI.
Yeah.
It's just going to be more. It's going to be slower, I think, than
By the way,
what a lot of people believe.
you are data scientist.
Yeah.
I imagine AI is helping you like tenfold from where you were a year or two ago.
So in our real estate business, we see hundreds of deals. So prop deals on the equity side and on the debt side. We're using AI to pull out of all of those, the most important indicators that I want to track over time. This is the first real tool we're using it in real estate, though. Now, JP Morgan as a bank is using it. We have our own internal large language models. We are finding efficiencies, I think, ahead of our peers. But in the real estate business, this is the first one. Mm-hmm. And what you can get out of that is a data hoarder's dream. More data even on deals we don't do.
Right.
And you get the pulse of where the market is. And it's helping us already in the sense that we can go back to anyone who wants to do a debt deal with us and say, no, that's not where the market is. Here's the market. Well, how do you know that? Well, here's all the deals that we've seen in the last 7 days. And also around the tariffs gave us some cool information. And around the tariff announcements, you were really only seeing changes in behavior in the industrial space, on the coasts, really in California. That's the connectivity of imports from China. And then also around really like housing and distribution assets. We didn't really see a change in price there, but we saw the amount of bidders showing up come down quite a bit. So, but even then around the tariffs, that was really all the impact that we saw.
Similar to the multi-asset class, BFR, SFR, whatever you want to call it, where's that place within JP Morgan's portfolio or outlook? What are you thinking about that market
For the last few years, we've been investing heavily in the space, and it's along that affordable or attainable housing theme. And when people are being displaced out of the American dream of owning a 3 or 4 bedroom house, this becomes the holding place. The critical thing for us was to do it in places where affordability, so owning was at least 20% more expensive than renting, and a place where we would see a natural affordability challenge beyond people that want to live there. The other piece of it too is making sure that they're not spending too much money on the rental. So if you're a $110,000 a year wage earner, you want to be below $3,000. And if the rents there were too high, we weren't buying properties there. But I think this is a solution to the housing problem.
Isn't that interesting? If the rents were too high, you don't buy properties there. That's like such an inverse thought for 99% of investors, right? You see like rents are booming, but it makes the most sense when you say it, right? If you're pricing people over that, what was the magic number? Like 30% of someone's income?
It's just too much.
Then
There's
it doesn't
no
make
insulation.
sense.
Yeah.
I like
Crazy.
that. I like that. There's no insulation, but there's also no outlook for pushing the rent higher. And what we're trying to do is triangulate all of those things.
Yeah.
But statistically, if you go in certain assets, like the lowest cap rate doesn't necessarily under or outperform. I think this is a going mindset. Statistically, people say, I just want to buy things really cheap. Buying things really cheap, they could be cheap for a reason. Buying something really expensive could be expensive for a reason. So you're trying to find those kind of middling areas where I can push the rent.
Yeah.
And I feel like I have the insulation, Jack, using your word now, that insulation to say, I feel good about owning this for 3 to 5 years.
No, it makes a ton of sense. It makes a ton of sense.
We're kind of running up on time, but let's talk about the thing that literally I get calls about every day. I'm sure you get calls every hour.
Office properties.
I was going to say not that, but interest rates.
Yeah.
Where are they? What's going to happen?
In a baseline scenario, so a couple ways to answer this. The first one is just, what's the Fed going to do? And in my time at the central bank, if you knew what the Fed was going to do, you would have really strong confidence what a 10-year treasury rate would be, which is where most banks and borrowers will benchmark any of their lending for real estate. That's not working as the same that it was when I was there. So what's the Fed look like they're going to do?
What do your insiders say there? I know you're well connected in the Fed from your time there. So do tell us what you're hearing. All the top secrets.
The Fed independence perspective is just so critical for the way that the modern economy here works. Why? Well, if inflation comes up, the Fed should hike rates and slow inflation so that we can prioritize a quality of life. Again, we are a special generation here. Our quality of life in this country has gained more than any generation ahead of us. Really powerful. What is quality of life? Your ability to consume and do what you want to do at a lower price point. So the Fed preserving independence is critical. Why? Because when they cut rates, the 10-year rate will come down. If they hike rates, the 10-year rate will come up. And most of us don't live in a cash world. You live in a 30-year fixed rate mortgage world where 90% of the world has their borrowings against their home. And so the Fed's independence is critical to keep this relationship. But it's not really working that way right now. You're seeing the market expect the Fed to cut, but the 10-year rate not coming down as much as you'd like. Some folks will just call that term premium. I hate that word because no one can understand it. It's a central banker not really helping anybody. But when we need this 10-year treasury rate to come down, the Fed's independence is necessary to get there. In my time at the Fed, I only saw one political thing happen, and it was a very senior person asking a junior person on my team, I'm glad you're going to vote. He had a Hillary Clinton button on. I'm glad you're going to vote, but we don't vote in here. You have to take that off. And that was the only political thing.
Wow.
And I just think in this country, it's a very important thing that we haven't had to focus on for a long time, but independence there gives us a lot of quality of life benefits. So hopefully that's going to happen. But outlook on rates, I don't think we're going to have a recession. President Trump and the administration are changing the tariff picture all the time. I don't think we'll have a recession. The Fed will probably cut a couple of times in the next 12 or 18 months. Maybe a 10-year treasury rate comes down to like 4%. So not that much. This new higher for longer interest rate world,
It's a real thing.
here. I think it's real. I do. I really do.
Of course.
Yeah. Okay. Well, on that note, thanks so much, Tom. It was a lot.
This is very
it was a lot
informative.
today. Yeah.
Too much data,
No,
but it was all
great.
great data, right?
I love it. I think you made some really interesting points, and like you changed my perspective about the
Same.
world a couple of times throughout this talk.
I'll have
So
to go
it's-
back and listen to it myself a few times. So
Yeah.
Good. Thanks for having me,
that
guys.
was great.
Yeah,
Thanks, Tom.
Thanks for coming down.